a few markets still closed and away on holidays today, but will we see a more positive reception to what was perceived as a more dovish Chair Powell during the press conference as expected?
Well, I think the Asian markets will take the news of a 50 basis point hike very well. I mean, we've had very, very tight monetary and financial conditions over the course of the last week. So a strong dollar, widening credit spreads for both corporates and sovereigns, and the potential for a much higher rate hike has actually given a nice backdrop for equity markets now, because most of that reversed very, very quickly in the last 12 hours. So Asian bourses, I think, will take the news very, very well. As I said, financial conditions were looking pretty difficult almost 24 hours ago.
That reversal in the dollar, especially sharp, where is it headed now, and what will really affect its course the rest of the year?
Well, I think that's really pertinent for our markets. I think the dollar became very, very overbought, and paradoxically, almost as strong as it was during the deflation scare of March 2020. So in many respects, the Asian currency should take some good news from the fact that they've been able to withstand a pretty strong dollar. I think most of the dollar weakness from here will actually come from the more major cross rates, yen, euro and pound, because they are anomalously cheap at the moment. But I think in all respects, Asian and EM currencies have held up well, and that probably means that risk assets do pretty well in this time zone over the next 24, 36 hours.
What about China as an emerging markets anchor, not just yuan, but of course the economy in general? What sort of impact do you expect to see, because the news flow just continues to be so bad?
Well, I think in some sense, China's running on a very different set of factors determining its bourses at the moment. Paradoxically, the worse the economic news gets, such as the PMI numbers or GDP numbers, the more the authorities are willing to do U-turns. And I think this symposium with the internet platforms probably is another sign that the authorities don't want to change rates. They don't want to do massive fiscal stimulus, but are actually much more willing to do reforms. And that, I think, actually provides a nice backdrop, possibly after the Congress, for the CSI 300 and hopefully for the HSI as well. So paradoxically, the markets may get things that are not necessarily interest rate sensitive or currency sensitive, but more on the reform agenda, which is generally good for equities.
The geopolitical piece, it feels in some respects like markets are uncomfortably, albeit uncomfortably, but sort of learning to live with this elongated risk now as we see the invasion of Ukraine by Russia just continuing. Where does that leave a player like China?
Well, I think one of the interesting aspects for China was that, again, talking about U-turns, Foreign Minister Wang Yi went on a flight to a series of countries that abstained against voting against Russia at the UN. One of them was India. So in terms of getting a cohesive force, China was very quick to establish that it wasn't just the only one that had interest with Russia. I think longer term, I suspect that the markets are already dividing the world up, and in that respect, for China, it's going to find that not only trade relationships will perhaps be a lot more difficult, but capital flow relationships. And I think that's what's underlyingly concerning most fund managers, is the risk of potential sanctions and the risk of their portfolios being changed, or the benchmarks being changed as to how they can include China in those portfolios. So I think it's a more longer-term capital flow question, really, for investors towards China, rather than perhaps worries about how the sort of Russia-Ukraine war pans out by itself.